So the next topic that we are going to learn in chapter number 8 is called as financial instruments. So in financial instrument, there are three standards that we are specifically have to know about, which is IFRS 9, IFRS 7 and IAS 32. IFRS 9 is the introduction, recognition and measurement criteria of the financial instruments. So how do you recognize financial instruments? How do you measure them? What are the conditions for measurement? We would have learned in financial reporting the business model, the cash flow model, what are the types of financial instruments. Everything is explained in the standard IFRS 9. IFRS 7 specifically talks about the disclosures, like how can you disclose them, what are the disclosure criteria which you need to follow when you are presenting it in the financial statement, in the disclosures and notes to the financial statements. And finally, IAS 32 talks about the presentation of the financial financial instruments in the financial statement. Like how do you present them? Like do you present it in the current liability, non-current liability, or equity versus non-current liability? For example, convertible debentures, you need to present it. It's a combined instrument, so which means it has debt as well as equity instrument, and it has to be presented in both. So you are required to know all these as part of your financial reporting and SBR studies. But I am not going to explain this in detail, but I have given you a reading material which will quickly summarize what are financial instruments and what are the accounting concepts of financial instruments. Do note them, do read them before you come and watch this particular question. Because it's in AAA, you might not have enough accounting knowledge, does not stop you from scoring marks. But unable to go in deeper and explaining them in the answer will make you fail the exam. So it's very important that you practice the questions along with watching and reading other materials as well. So when I'm giving you reading materials, it will inculcate your knowledge and it will inculcate a habit within you to go and read more and gather knowledge which can be used in the examination as well. So let's try to learn this particular activity. Before we do that, please do read the reading material relating to financial instruments, which is a short summary of what is financial instruments. As well, do read I would say do definitely read the other materials that I have given to you as well, which will help you for the substantive procedures with respect to the financial instruments. So look at here, activity number 3. You are the audit manager of the audit of Holy Company. The audit team have left the following information for your attention. In November 2007, Holy purchased 500,000 shares in Buddy Co. This purchase gave Holy approximately 18% of the issued share capital of Buddy. The shares were purchased for $2 each, and the transaction cost to 1% to the value of shares. The finance director of Holy Co. stated that he has no intention of selling the shares in the near future, as he doesn't like to speculate and he sees that this is a long-term investment that he may add to the future. The share price of the Buddy at the year end was $2.25. You should assume that the purchase price of shares and the transaction cost are both material to the financial statements of Holy Company. In respect of the audit of this transaction, comment on the matters you should consider, the evidence you would expect to find. So here the situation is very simple. You are the audit manager of Holy Co. Company, and Holy Co. Company purchased 500,000 shares in Buddy Co. Company. So they are now having around 18% of ownership in Buddy Co. So whenever you hear the term, okay, 18%, 500,000 shares, what are the things or what are the standards that should come to your mind? Okay, whenever we hear the term, okay, 500,000 shares, okay, what are the things that should come to your mind? So whenever a company, let's in this situation it is Holy Co, right? So Holy Co purchased 500,000 shares, okay, 500,000 shares in Buddy Company. Okay, so this is the situation. So Holy Co purchased 500,000 shares in Buddy Company. Now Holy Co is a part owner. He is a part owner of Buddy Company. Now the question is the ownership percentage is 18%. So the ownership percentage is 18%. Now, what is the biggest risk here? If the ownership percentage was 20%, then buddy company would have been an associate entity. And if it was an associate entity, then it would have to be treated under IAS 28, investment in associates. But here it is not the situation. They have purchased only 18%. But what is the risk? Are we sure that it is only 18%? What if it is 20%? So we need to verify this ownership percentage. So the auditor, we are the auditor. So we need to verify this ownership percentage. That is number one. Right. So we need to verify this ownership percentage, whether wholly company purchased 18% or the ownership is more than 80% or not. So we need to verify that. Second, we have 500,000 shares. So 500,000 shares will give us share certificates worth 500,000. We need to verify the share certificate ownership as well. Whether 500,000 shares is actually true or is it not true? Is it more than that, less than that? We need to have evidence whether the 500,000 shares is substantially true and correct as well. And then this 500,000 shares which wholly company have purchased, the third thing we need to verify is the treatment of this particular. So this is the second thing, the third thing that we need to verify is the treatment. So if it is not IAS 28, then as per IFRS 9, how have you treated it? Have you treated the fair value to OCI or the fair value to P&L? So as per IFRS 9, for any investments in shares, equity instruments, we have two options. One is fair value to OCI, another is fair value to P&L. Whether the company wholly co has made an election, irrevocable election, to carry the financial instrument to fair value to OCI. If yes, then have they taken the fair value changes to OCI? Recalculate the fair value changes. If not, the fair value changes have to be taken to P&L. So these are the three things that we need to verify. So these three things will become our risk element. So these are the matters that we are supposed to consider. Okay, these are the matters that we are supposed to consider. So let's now write the solution to this particular answer. So whenever you're writing the solution and a question where we are going to first write about the matters to consider, the first matter always to consider will be materiality. Now, when we are writing AA, materiality calculation was not an important task. Like it may be either given to you or they might not. Even if materiality was not calculated, it was fine. But you need to understand that when it comes to AAA, materiality calculation is very important. If you don't calculate the materiality, you might lose 1 mark. Specifically, you might lose professional marks as well. So it's a very important way to score professional marks is to calculate the materiality. So, but in this particular question, the materiality have already been assessed. So materiality have already been assessed. Materiality is already assessed. But if not, then you need to calculate it specifically. So assessed already. So which means we don't, because they have not given anything specific to the materiality, we can ignore that fact. But during the exam, always write the first of the materiality, calculate the materiality and keep it. The second thing that you're going to write is all about the risk. Now, when you consider the risk, what are the risks that you need to include? As I told you, 3 things, right? So here, the first one, which we talked about is the, standards as well as the accounting treatment will be considered for the risk element. So the number of shares, what you can write is the number of shares number of shares owned in buddy company, buddy co, is 18%, right? If wholly company stake was 20%, then as per IAS 28, this would be accounting for associates. And treatment would be as per equity method of accounting. Okay, so this is the number one risk. All right. So if this is just investment, then we need to confirm the business model as well as the cash flow model. So in this continuation, we can write that if this was just an investment, of 18%, then the shares of the buddyco would need to be confirmed to ensure that holdco has the right on these shares for the statement of financial position, and they are entitled to any dividends. So if this is just an investment of 18% of shares of buddy company, then ownership of these shares would need to be considered and verified as well to need to ensure wholly company have rights to dividends. So whether wholly company have the rights to receive dividends or not have to be verified. So that is we need to verify. If, let's say for example, the shares of 18% is just a mere investment, but if it is more than 18%, then it will come under investment in equity and investment. So we need to verify the ownership percentage. That's what we are trying to tell you. So based on this, we need to ensure that ownership percentage have to be verified. Ownership percentage needs to be verified. Ownership percentage to be verified. Okay. Now, the second thing that we need to ensure. Okay, the second thing that we need to ensure is, okay, is that as per the wholly company has no intention, okay, they have no intention to sell the shares and wants hold it for a long-term period. So want to hold for a long-term period. So they want to hold it for a long-term period. So this is something, it's very important, because then as per the business model test, as per the, I'm just writing as BM is business model test. Wholly company has intention to hold till maturity. so they have option, which means they have option. So wholly company have option to take the fair value changes, to P&L or OCI. But if they are taking the fair value changes plus the transaction cost to OCI, then they have to make an irrevocable election. So hence you need to write, if wholly company wants to take fair value to OCI, then an irrevocable election is required to be made at initial recognition, to take the fair value changes to OCI, So, which means the auditor have to ensure that the fair value changes have been taken to OCI and not taken to P&L, and the transaction cost as well can be taken to OCI and not expense to P&L. So which means auditor, what are we? We are the audit manager. So auditor need to ensure fair value changes and transaction cost are taken to OCI and not recognized in P&L. This is something that they need to verify. So this is the second thing, the next thing that I told you. So verification of ownership, verification of the 18% already covered in point 1. Then fair treatment of the financial instrument already covered in now. Now the next one is about disclosures. So the third point we are going to write about is the disclosures. So IFRS 7, the disclosures specifies that the financial statement should disclose. So IFRS 7 specifies that the financial statements should disclose both significant influence and the nature of any risk with the financial instrument with respect to the level of market risk of the shares to represent to wholly. So significant influence and the nature or risk associated with the financial instrument. So risk associated with the financial instruments, including an estimate of level of market risk the shares represent to wholly. So the market risk the shares represent to wholly, that should also be disclosed in the financial instruments disclosure. So you need to not just write about the significant influence or what are the nature of the investment, but also you need to write about the risk associated with the financial instruments as well. That is what the disclosure specifically talks about. So whenever you're given a financial instrument kind of an treatment in your scenario, this is how you need to explain them in your answer. Now the second question is all about the evidences. So here they are asking you or comment on the evidences you should expect to find. So let's now write about the evidences. So evidences that you expect to find. What are the evidences you can expect to find? Firstly, copies of the share certificate. So copies of share certificate. I'm just going to write the summary of the evidences. So share certificate, copies of the share certificate in which the ownership name should be wholly company. So the name of the ownership should be wholly company's name. So that should be mentioned. Okay, and this should be as at 30th November 2007. For how many shares? Of 500,000 shares. So we need to get the ownership certificates of those 500,000 shares as at 30th November, which was mentioned in the name of wholly company from Buddyco. So Buddyco is issued by Buddyco, their share certificate, which is in the name of wholly company, have to be taken. That's the number one. Okay, that's the number one. If wholly company is a listed company, then you can also verify the stock exchange. Whether, if Buddy company is listed company, then you can also verify the stock exchange. So verify the stock exchange data to see if wholly company name is mentioned as owner of Buddyco. So you can go to the relevant stock exchange website. So every company will have a stock exchange website. You can find the Buddyco's website, data over there. And if you open Buddyco's data, you will come to know who are the owners. You can get there. From there, you can actually identify what is the number of percentage, what is the number of shares which are invested by wholly company. All of those things you will find out there itself. So that also is a third party source, which is a good evidence as well, because you're collecting the information not just from internal document, but also a third party source, which is a stock exchange website, which is a direct evidence as well. Okay, which is a direct evidence as well. Now we need to verify whether the 18% is correct or it's more than 18%, right? So we need to verify the inspection of what we need to inspect: Buddy company's statutory records, which again can be available from the stock exchange website. All right. So you can open the stock exchange website to see how much number of shares have been issued by Buddy company. So 500,000 shares, right? If we have issued, total Buddy shares is issued, close to. So if 500,000 shares is 18%, then total shares which have been issued by Buddyco would be around 27 million shares, approximately 27,700 something shares. So whether we need to verify the total shares which have been issued to all the shareholders by Buddyco multiplied by 18% is coming 500,000 shares or not. Because the problem is, if 500,000 shares that is purchased by wholly company, but Buddy company has issued only less than 25 million, then the percentage will become more. It will becomes 20% or more than that. So we need to verify the 500,000 shares represents only 18% of Buddy company or not. Right? So we need to ensure that inspection of board statutory records to verify wholly company owns 18% of all shares issued by buddy company and review board minutes to check whether holding company who has any significant influence over buddy company or not. So we need to verify whether holding company has a significant influence over buddy company. And how will you verify that? Through board minutes. If the board of directors of holding company and the if the board minutes of buddy company, they kind of sync together, and the whole board of minutes of holding company, the board of directors are taking certain decisions for buddy company, then it says that actually the board of directors of holding company have influence over the buddy company. You can also get external confirmation as well. You can reach out to buddy company and check what is the ownership percentage and also verify whether there is any significant influence as well. That is also possible. But it's not necessary if we are able to get other details. The third one is then verify the payment. So when you are purchasing a investment, you will debit investment and credit cash. That's the journal entry. So when in holding company's books, okay, the journal entry would be debit investment, okay, and credit cash. So we can verify this through share certificates. This how will be verified? Through bank statement. So the third point is to inspect the bank statement. Inspect the bank statement and cash book to confirm the transaction occurred in November 2007. Okay, November 2007. The fourth one is we need to recalculate the purchase price, recalculation of payment. So we can do that. We can say that recalculate the payment price to see if it makes sense, right? So what is the payment price? Which is $2 into 500,000. So that will be equal to $1 million. So we can verify that. And also we need to recalculate the transaction cost. What is your transaction cost? Your transaction cost is 1% of the purchase price. So 1% multiplied by $1 million. So that is equal to $100,000. All right. And then match to what? To the financial position, statement of financial position and expense or OCI in statement of profit or loss and other comprehensive income. So am I writing expense / OCI? Because the transaction cost can be dependent based on the treatment. So if they are treating to OCI, then the transaction cost will also be taken to OCI. If they are treating to as fair value to P&L, then the transaction cost will be expense to P&L. So that we need to verify. So which means the next point we need to identify is to get a written representation, to obtain. So obtain written representation from the finance director that regarding, I would say regarding, okay, regarding the business model of holy company for investment in body co, right, and the treatment of the fair value changes, whether it will be to P&L or OCI. Okay, that we need to understand. And if it's to P&L or to OCI, then we need to trace them. So trace the transaction cost to P&L or OCI depending upon the election based on the election made. Okay, and then finally during the year end, recalculate the fair value changes. So calculate the fair value changes. How can you recalculate the fair value changes? That's very simple. So the recalculation of a fair value changes is very simple. How can you recalculate the fair value changes? Fair value at year end. What is the fair value at year end? $2.20 into 500,000. How much is that? 2.25, not 2.20, 2.25 into 500,000, which is $1,125,000 minus fair value at purchase price, so at initial, which is $2, right? So that is 2 multiplied by 500,000. Okay, multiplied by 500,000, and then so that is close to around 1 million. So which means the fair value changes will be 25,000. Now if the company is making an irrevocable election to OCI, then here in this particular amount can include the transaction cost as well in this amount. I'm sorry. So it will become 1 million and 100,000. So 1.1 million it will become. So the transaction cost can also be included. So the transaction cost, I think I incorrectly mentioned as 100,000, but that is 10,000. So transaction cost is 1%. So that will be 10,000 instead of 100,000. So if it is fair value to P&L, then this will be the treatment. So, and this will go to P&L. So the the entry will be debit financial instrument asset, which is investment with respect to 25,000, and credit P&L with respect to 25,000. If the fair value changes were made to OCI, so if the fair value to OCI was made, then our fair value at year end will be $1.125 million minus fair value at initial investments will be $1,010,000. So then the difference would be close to around $115,000. So it's not 25,000, 125,000. I'm sorry, my maths is a bit poor today. So 125,000. So here it will be $115,000. So this entry would be debit investment, which is the financial asset, so which is 115,000, and credit OCI 115,000. This will be the entry. So this is why the election or the classification of financial instruments, whether to P&L or OCI, becomes very crucial here. You need to recalculate and ensure that the treatment have been taken to correctly or not. You can also inspect, you can also write that to inspect the journal entry. So that can also be another pointer. So 8th point can be to inspection of journal entry. So inspect journal entry of these fair value changes, right? So these journal entries you can inspect. And finally, you can review the financial statement and ensure that the disclosures are appropriate and all the disclosures, including the levels of risk, the market risk, are also appropriately presented or not. That can also be represented very clearly. Whether they have been represented very clearly or not, you can check that.